Well, for more, let's bring in Mike Labella, Senior Portfolio Manager at Franklin Templeton, and Michael Aroni, Chief Investment Strategist at State Street Global Investors. We've got M&M here, Mike and Michael here. Good morning, or I guess I should say good afternoon to you both. Mike Labella, I'll start with you. What do you think about valuations here? And given the fact that we are starting to get earnings, and in many cases earnings that are topping expectations, is that a case to be had for valuations maybe not seeming as stretched as they currently are?
Look, valuations are at record levels. Depending on how you look at it, they can be either as high as the late 1920s or even approaching levels we saw in the dot-com bubble. And there are certainly pockets of the market where there does appear to be froth. Now, with that said, you can't look at valuations in a vacuum. You have to understand what the earnings picture is going to look like on a forward basis, but you also have to think about the path of interest rates. And considering how low rates are and how they're expected to stay low, when you actually look at valuations on an interest rate adjusted basis, they don't look as stretched as the headline numbers are. So as the economy starts to improve and earnings start to rebound, interest rates are likely to stay stable. The valuation picture probably isn't going to be worrisome. Now, the two big caveats to that is if we start to see faster movements in rates moving to the upside, or if we start to see more disappointment on the earnings perspective, that valuation could look a lot more worrisome at the end of the year.
All right. Michael A., I want to get your thoughts on this, too. How do you see valuations right now with stocks at record highs?
Well, I think when the Federal Reserve holds interest rates at basically permanently zero, who cares about valuations? And I think investors have largely reflected that. I think what's interesting is in the aftermath of the global financial crisis, we all glommed onto this acronym RORO, risk on, risk off. The market was trading in a very binary fashion. At the start of 2021, what's interesting here during the pandemic is there's a new acronym, and it's GO-GO, growth on, growth off. So regardless of valuations, what we're seeing is that when investors become skeptical about the economic recovery, they go to the security blanket, which is large cap, reliable growth bank stocks. And I think that's largely what's driving market dynamics today.
Shepard Smith here. Thanks for watching CNBC on YouTube.